students, welcome to the lecture on financial statement and cash flow. And after the lecture, we will be able to learn the following objectives. Explain the concept of ratio analysis, describe the solvency ratios, discuss the profitability ratios, explain the activity ratios, define the liquidity ratios, understand market capitalization ratios, explain the comparative balance sheet, discuss the trend analysis of manufacturing, understand the funds flow statement. Let's start with a brief introduction of financial statement and cash flow. Financial statement analysis is defined as the process of identifying financial strengths and weaknesses of the firm by properly establishing relationship between the items of the balance sheet and the profit and loss account. Financial statements are prepared to meet external reporting obligations and also for decision-making purposes. There are various methods or techniques that are used in analyzing financial statements, such as comparative statements, schedule of changes in working capital, common size percentages, funds analysis, trend analysis, and ratios analysis. Tools and techniques of financial statement analysis: horizontal analysis, vertical analysis. Horizontal analysis. Horizontal analysis of financial statements can also be carried out by computing trend percentages. Trend percentage states several years of financial data in terms of a base year. The base year equals 100% with all other years stated in some percentage of this. Vertical analysis. Vertical analysis is the procedure of preparing and presenting common size statements. Common size statement is one that shows the items appearing on it in percentage form as well as in dollar form. Each item is stated as a percentage of sum total of which that item is a part. Funds flow statement is a modern technique of analyzing financial statement. Fund flow statement shows as to where have the funds come from and where they have been used during the accounting period. The funds flow statement is a statement which shows the movement of funds and is a report of the financial operations of the business undertaking. Let's now take a look at ratio analysis. Ratio analysis is a financial technique that involves dividing various financial statement numbers into one another. Ratios are computed by dividing one amount on the financial statements into another. Ratios are valuable tools as they standardize balance sheet and income statement numbers. Three basic categories of ratio analysis are used. Trend or time series analysis uses ratios to evaluate a firm's performance over time. Cross-section analysis uses ratios to compare different companies at the same point in time. Industry comparative analysis is used to compare a firm's ratios against average ratios for other companies in the same industry.
Now we'll start ratio analysis. Means analysis of the financial statements through ratios. Actually, ratios, I mean to say accounting ratios, are the one of the tools to analyze final accounts. To analyze financial statements means to study all the figures of the financial statements and reach the logical conclusion. Be careful. What we will try to do, we will convert the absolute figures to relative figures so that they can be compared more logically. For example, if you are trying to compare the marks of accountancy and the marks of science, it's totally different subjects. It's a useless comparison. Or otherwise, if somebody says that he has got 10 marks and B says that he has got 20 marks, and you are trying to compare these two marks, it's useless, because first of all, you should ask him out of how many marks he has got. Suppose A has got 10 marks out of 10 and B has got 20 marks out of 100. It means A has got 100% and B has got only 20%. And previously you are trying to compare the absolute values, 10 marks and 20 marks. And you could reach the wrong conclusion that B is more capable. But when you come to know that A has got 100% marks and B has got only 20 marks, now you reach the conclusion that A is more capable. So in this way, you should never try to compare absolute figures. They should be converted into relative figures. And in the whole chapter, what we'll do, we'll study the financial statements and we'll change the absolute values available in the financial statements into the relative values.
Advantages of ratios analysis. Simplifies financial statements. It simplifies the comprehension of financial statements. Ratios tell the whole story of changes in the financial condition of the business. Facilitates inter-firm comparison. It provides data for inter-firm comparison. Ratios highlight the factors associated with successful and unsuccessful firms. They also reveal strong firms and weak firms, overvalued and undervalued firms. Helps in planning. It helps in planning and forecasting. Ratios can assist management in its basic functions of forecasting. Makes inter-firm comparison possible. Ratio analysis also makes possible comparisons of the performance of different divisions of the firm. The ratios are helpful in deciding about their efficiency or otherwise in the past and likely performance in the future. Help in investment decisions. It helps in investment decisions in the case of investors and lending decisions, in the case of bankers, etc. Limitations of ratios analysis. The ratios analysis is one of the most powerful tools of financial management. Though ratios are simple to calculate and easy to understand, they suffer from serious limitations. Limitations of financial statements. Comparative study required. Ratios alone are not adequate. Problems of price level changes. Lack of adequate standard. Limited use of single ratios. Personal bias. Here we will discuss about the solvency ratios. The solvency ratio measures the size of a company's after-tax income, excluding non-cash depreciation expenses, compared with the firm's total debt obligations. It provides a measurement of how likely it is a company can continue to meet its debt obligations. Solvency ratios measure the financial soundness of a business and how well the company can satisfy its short and long-term obligations. Quick ratio. This ratio, also called acid test or liquid ratio, considers only cash, marketable securities, cash equivalents, and accounts receivable, because they are considered to be the most liquid forms of current assets. A quick ratio less than 1.0 implies dependency on inventory and other current assets to liquidate short-term debt. Current ratio. This ratio is a comparison of current assets to current liabilities. Commonly used as a measure of short-run solvency, that is, the immediate ability of a business to pay its current debts as they come due. Current liabilities to inventory ratio. This ratio shows as a percentage, the reliance on available inventory for payment of debt. Fixed assets to net worth ratio. This ratio shows the percentage of assets cantered in fixed assets compared to total equity. Generally, the higher this percentage is, over 75%, the more vulnerable a concern becomes to unexpected hazards and business climate changes. Capital is frozen in the form of machinery, and the margin for operating funds becomes too narrow for day-to-day operations. Let's get to know about profitability ratios. Profitability ratios are useful in fundamental analysis, which investigates the financial health of companies. An example of a profitability ratio is the return on investment, which is the amount of revenue an investment generates as a percentage of the amount of capital invested over a given period of time. Let us now take a look at activity ratios. Activity ratios, also known as efficiency or turnover ratios, measure how effectively the firm is using its assets. Some aspects of activity analysis are closely related to liquidity analysis. Working capital accounting ratios that measure a firm's ability to convert different accounts within their balance sheets into cash or sales. It depends upon the size and nature of the business. Fixed assets turnover ratio. It indicates whether investment in fixed assets has been judicious or not. The ratio is calculated as working capital equals current assets equals current liabilities. Let's now have a look at liquidity ratios. Common liquidity ratios include the current ratio, the quick ratio, and the operating cash flow ratio. Different analysts consider different assets to be relevant in calculating liquidity. A company's ability to turn short-term assets into cash to cover debts is of the utmost importance when creditors are seeking payment. Current ratio. Current ratio is widely discussed in the financial world, and it is easy to understand. However, it can be misleading because the chances of a company needing to liquidate all its assets to meet liabilities are very slim indeed. A high current ratio could indicate that too much money is tied up in current assets. For example, giving customers too much credit. Cash ratio. This indicates liquidity by measuring the amount of cash, cash equivalents, and invested funds that are available to meet current short-term liabilities. The cash ratio is a more conservative measure of liquidity than the current ratio because it not only looks at assets that are already liquid, ignoring assets such as receivables or inventory. Quick ratio. The third liquidity ratio is a more sophisticated alternative to the current ratio, which measures the most liquid current assets excluding inventory, but including accounts receivable and certain investments. The quick ratio should be around 0.7 to 1, with very few companies having a cash ratio of over. To be absolutely safe, the quick ratio should be at least 1, which indicates that quick assets exceed current liabilities. If the current ratio is rising and the quick ratio is static, it suggests a potential stockholding problem. Liquidity of inventory. To help determine how effectively the firm is managing inventory and also to gain an indication of the liquidity of inventory, we compute the inventory turnover ratio. It shows how quickly inventory is sold and is determined by inventory turnover ratio, ITO. It is the number of times the company sells turns over inventory during the year. Let's now take a look at Market capitalization ratios. Market capitalization, MC, is calculated by multiplying the current market price, CMP, of a share by the total number of shares issued by the company, NS, with the formula MC equals CMP multiplied by NS. Market capitalization represents the market value of a listed company, and it reflects the public opinion on the net worth of the company, and it is a basic determinant in evaluation of shares. Market capitalization is just a juggled name for a simple concept. It is the market value of outstanding shares of a company. Let's now get to know about comparative balance sheet. Comparative financial statement analysis provides information to assess the direction of change in the business. The financial statement balance sheet indicates the financial position as at the end of an accounting period and the financial statement. The comparative financial statement provides information about 2 or more years' figures as well as any increase or decrease from the previous year's figures and its percentage of increase or decrease. Comparative financial statement analysis in such situations helps to find out where costs have increased, which has resulted in lower net income than the previous year. Here we will discuss about the trend analysis of manufacturing. Manufacturing companies have several different accounts compared to service and merchandising companies. These include 3 types of inventory accounts: raw materials, work in process, finished goods, and several long-term fixed asset accounts. A manufacturing company uses purchased raw materials and/or parts to produce a product for sale. 1. A current ratio is considered good as it indicates the company has twice as many assets as liabilities and thus greater financial stability. Current ratio equals current assets divided by current liabilities. 2. The higher the inventory turns, the faster the company sells its goods, decreases its warehousing costs, and increases its cash flow. Inventory turnover equals cost of goods sold divided by inventory. 3. A high accounts receivable turnover indicates that the company is able to receive cash from sales to its customers relatively quickly. Accounts receivable turnover equals total net sales divided by accounts receivable. 4. The higher the gross profit margin, the more profit the company makes from its products. Gross profit margin equals gross profit divided by total sales. 5. A lower debt to equity ratio indicates the company has less debt, is more financially stable, and in a good position to obtain loans. A higher ratio carries a higher credit risk. Debt to equity ratio equals total liabilities divided by total shareholders' equity. Let's now take a look at funds flow statement. The funds flow statement is the earlier version of the statement of cash flows that is now required to report changes in an entity's cash flows during an accounting period. The funds flow statement primarily reported changes in an entity's net working capital position between the beginning and end of an accounting period. Net working capital is an entity's current assets minus its current liabilities. Cash flow statement direct method. The direct method of presenting the statement of cash flows presents the specific cash flows associated with items that affect the cash flow. The advantage of the direct method over the indirect method is that it reveals operating cash receipts and payments. However, the method is rarely used because few organizations aggregate cash flow information in the manner required, reporting under the direct method. Cash flow statement indirect method. Under the indirect method of presenting the statement of cash flows, the presentation begins with net income or loss, with subsequent additions to or deductions from that amount for non-cash revenue and expense items, resulting in net cash provided by operating activities. Here we will discuss about preparation of funds flow statement. Funds flow statement is prepared and interpreted on the basis of a net working capital concept. Funds flow statement measures and presents, in an analytical manner, the summarized version of the numerous flows of funds for a specific period. Fund transactions. There is plenty of business transactions which result in flow of funds or which cause changes in working capital. For this purpose, all the business transactions are classified into A. Those transactions which increase funds, that is, sources of funds, and B. Those transactions which decrease funds, that is, application of funds. The following transactions do not affect the flow of funds. These are 1. Transactions between two current assets. 2. Transactions between two current liabilities. 3. Transactions between current assets and current liabilities. 4. Transactions between two non-current or fixed assets. 5. Transactions between two long-term liabilities. 6. Transactions between non-current assets and long-term liabilities. Preparation of funds flow statement and its analysis. However, the technique of cash flow statement, when used in conjunction with ratio analysis, serves as a barometer in measuring the profitability and financial position of the business. The preparation of funds flow statement has the following steps. Schedule of changes in working capital. Fund flow statement. Let's now have a look at the statement of cash flows. A cash flow statement is a document prepared by a company that details how much money is flowing in and out of the business. The statement of cash flows is quite useful in revealing the existence of cash flows that are not readily apparent from the results listed in the income statement. The statement of cash flows contains information about the flows of cash into and out of a company. In particular, it shows the extent of those activities that generate and use cash. This statement comprises part of the financial statements, though its importance has historically been considered less than income statement and balance sheet. Let's now take a look at the preparations of cash flow statement and its analysis. Cash flow analysis is a method of analyzing the financing, investing, and operating activities of a company. The primary goal of cash flow analysis is to identify in a timely manner cash flow problems as well as cash flow opportunities. The cash flow statement. A typical cash flow statement is divided into three parts. Cash from operations, from daily business activities like collecting payments from customers or making payments to suppliers and employees. Cash from investment activities, the purchase or sale of assets. And cash from financing activities, the issuing of stock or borrowing of funds. Cash flow statements facilitate decision-making by providing a basis for judgments concerning the profitability, financial condition, and financial management of a company. The cash budget. In contrast to cash flow statements, cash budgets provide much more timely information regarding cash inflows and outflows. Cash budgets provide much more detailed information than cash flow statements. Generally speaking, the cash budget is grounded in the overall projected cash requirements of a company for a given period. Ratio analysis. Ratios facilitate comparisons with similar ratios of prior years of the same company, as well as comparisons of other companies. While ratio analysis may be used in conjunction with the cash flow statement and/or the cash budget, ratio analysis is often used as a standalone, attention-directing, or monitoring technique. Now, in the end, let us summarize what we have learned in this lecture. Horizontal analysis of financial statements can also be carried out by computing trend percentages. Trend percentage states several years' financial data in terms of a base year. Ratio analysis is a financial technique that involves dividing various financial statement numbers into one another. Ratios are computed by dividing one amount on the financial statements into another. Profitability ratios are useful in fundamental analysis, which investigates the financial health of companies. Activity ratios, also known as efficiency or turnover ratios, measure how effectively the firm is using its assets. Some aspects of activity analysis are closely related to liquidity analysis. Market capitalization is just a juggle name for a simple concept. It is the market value of outstanding shares of a company.